Good morning. This is Brad Shively from Capital Management Corp. Today is July 31st, 2019, and welcome to the second quarter review and outlook call for Capital Management Corporation. My name is Brad Shively again, and I have with me Tim Call, Chief Investment Officer and President of Capital Management Corp, and Mark Livesay, Vice President and Portfolio Manager. We will have a brief slide deck here this morning that we will go through. First off, I'll start off with a few opening remarks. We'll have some closing remarks, and then we'll open up to Q&A. And once again, if you have any questions you'd like to ask, please type them in, and we will address them as we receive them. Just starting off, how have the tides changed through the first half of 2019? Last December, equity markets were tanking, credit markets were seizing up, and inflation expectations were falling. The Federal Reserve still raised rates, signaling the shrinking of its balance sheet was the Fed's new path. Yet further market volatility soon caused central bankers to reverse course weeks later. Fast forward to today, and equities are at new highs, credit risk premiums are low, and inflation in the second quarter showed signs of a modest comeback. Yet the Fed is signaling its first rate cut since 2008, which we should find out here shortly. We believe the U.S. economy is stronger now than it was to start the year, as the job market and consumer spending remain robust. When we look at GDP growth of 2.1% in the second quarter of 2019, the biggest weaknesses came from business investment, exports, and inventory adjustments. At this point, I'm going to pass it over to Mark.
Thank you, Brad, for the introduction. I'm going to work quickly through some of these slides so we can get to questions. The first one is about headlines, and there's always going to be headlines. If you follow all of them, it can certainly be dizzying to figure out what's going on. I think today, if there was a headline, it would only be 3 letters on this page, and those would be FED. I think the press and the markets are squarely concentrated on what the Federal Reserve is going to do later on this afternoon. So on the next slide, we try to simplify the picture a little bit and give our perspective on what's going on. On the left, you have the potential negatives stacked up: yield curve, tariffs, geopolitical conflict, potential recession. Of those, geopolitical conflict, I think, is going to be constant. If we do get to a point where there's no geopolitical conflict, that would be great, but that's unlikely. The yield curve is inverted at the short end, so we'll talk about that a little bit more. The tariffs continue to go on. There have been talks today, and they will continue apparently in September, so that's an ongoing issue. The odds of recession, in our opinion, are very low, primarily because of the items on the right side that are really highlighted by the consumer and how healthy the consumer is right now. So the consumer is roughly 2/3 of the economy, doing very, very well. So we feel really good about where the U.S. economy is. So employment is near record highs, or unemployment near record lows. We have loads of money coming in from tax repatriation. Regulation is lower. The Fed is now reversed course, becoming easing versus being hawkish. Growth has been strong in the U.S. and corporate earnings, although there was a fear that we might have a decline in corporate earnings this quarter. It looks like we will not. We're still in the middle of earnings season, but it looks like so far we will not have a decline in the earnings. So on the next page, we show the yield curve, which has been talked about a lot. So now if you have a picture to go with what people say, the dotted line is the more normal scenario, which we had at the end of 2013, where if you lent someone money, they would have to pay you more interest per year based on how many years you loaned to them for. We have an unusual situation at the end of the second quarter, and it looks similar today, where short-term rates that the Fed controls on the y-axis are actually higher than longer-term rates going out to 10 years. So that's an unusual situation. We believe it's being caused primarily by international rates being so low. Non-US rates are incredibly low. Germany and Japan have negative rates at the 10-year. Switzerland, apparently yesterday, the 50-year note in Switzerland went negative. So if we were in Switzerland and you wanted to loan the Swiss government money for 50 years, you would have to give them more than they would eventually give you back. So if anyone would like to loan me money for 50 years at a negative interest rate, please alert me immediately. I'd be happy to take that. It's ridiculous that interest rates are so low, but they're pulling down our interest rates. So we think the yield curve in the U.S. is a little bit skewed today, and it otherwise would be positively sloping based on what's going on just in the United States. And I'm going to pass it to Tim to expand upon what we think the Fed might do.
So the Federal Reserve later today is expected to lower interest rates. They control the overnight interest rate. They haven't lowered it for around 10 years. And this is a reversal as to what they were doing at the end of last year. They're doing this because of the inverted yield curve. Generally, you'll want the yield curve to be upward sloping. That's better for the banks and for the economies. So it appears they raised interest rates a little too much last year. When we look at this chart, at the bottom of the chart, the numbers reflect what the interest rates are if we subtract inflation. So nominal means what people see as interest rates, and real is, nominal is what you see with these interest rates, and real would be the nominal interest rates minus inflation. So usually when, for the last 30 or so years, when you're entering a cycle where you're cutting interest rates, you're starting at a much higher level. The real interest rate, the amount interest rates are above inflation, is usually 3 to 4%. And right now it's closer to 0. So if the Federal Reserve cuts interest rates by 1/4 to 1.5% today, the real interest rate in the United States will be 0. You don't get any benefit. You don't get any earnings net of inflation from investing in bonds. This is highly unusual to occur in the first place. It just doesn't occur. And then on top of that, to be lowering interest rates and have a 0 real interest rate when the economy is already growing and is rather healthy, as Mark said, with full employment. When we look at the next chart, you'll see economic growth, and some are worried that second quarter growth was a little slower than first quarter. But if we take out some transitory items like an inventory adjustment of around 0.8%, then growth didn't really slow. So here we are, the United States economy continuing to chug along. It's the largest and most diverse economy in world history. It's going to take a little bit more to slow it down. And I'm going to turn it over to Mark to talk about why we don't believe the economy will slow, given its major components are growing.
Thanks, Tim. So it's important to remember, I believe, what the components are of the economy. So a little more than 2/3 is consumption. That's the consumer, and that's the piece of the economy that's doing quite well, with wage growth, unemployment at record lows, energy prices at reasonable levels. So most people that want to find a job are able to find one. There's actually more job openings than applicants, which is unusual. Another big piece of the components of GDP for the U.S. is government spending. So if you add those two up, it's close to 88% with housing. And government spending continues to be very high. There was a headline on the front page of the Journal yesterday to the point that the Treasury is going to issue $1 trillion in bonds, and no one seems to care. And that's been the case for 20 plus years. It doesn't matter what the political situation is, but government spending continues to rise. So we don't see an imminent decline in government spending. The most recent budget is certainly not for that. So we think those two pieces are going very, very well. The housing market has recovered in most parts of the United States. Housing starts will go up and down with weather, interest rates, and another big item is availability of labor. So if you can't find people to build the houses, you can't build as many as maybe you wanted. But the housing market, we believe, is quite strong, and the lower interest rates are going to be helpful for that. Investment ex housing, roughly 15%, a little less than 15%, is humming along, not quite as well as the other sectors, but it's small. This is the area that would probably most be impacted by tariffs, as company decisions may be delayed. We don't think this is going to last for forever, but if you see headlines or read about PMI going down or being slightly above 50, which is still growth, but it's not quite as good as the rest of the economy, you have to remember that it's less than 15% of the total. So when we add all these up, we think 85% is doing really, really well, and maybe 15 is just kind of doing ho-hum, but we don't see a recession risk as being very high at this point. So we feel good about the economy. The other thing you have to think about, of course, is the valuation of the market. So you can have a good economy, but if you have a very expensive market, like we did in the late 90s, you might not have forward returns that are very good. So this is just the forward PE of the market. We're right in line with averages, the 25-year average, so we're slightly ahead of it based on the recovery year to date. So we don't think valuation is very onerous to the market right now. We do think there are areas of the market which are expensive. So you can find stocks that are very, very expensive, that are trading at 10 plus times sales. But the nice thing about having a concentrated portfolio is you don't have to invest in those stocks that you find very, very expensive. So we can have a concentrated portfolio of small and mid cap stocks, large cap stocks that trade at below market multiples, but we think are going to grow in line or more than the market. So we think the valuation is attractive, particularly when you consider that bond rates are so low. So typically low bond yields or bond rates will correlate with higher PE ratios. And right now, bond rates are very, very low, and the PE is somewhat average. So we feel pretty good about where the market is. And I'll pass it over to Tim once again to kind of sum up the bulk of our thoughts.
When we look at the economy, we actually see it as very strong. So you might hear in the media or elsewhere a lot about the concerns, and we wrote down some of our reasoning for why the economy, the economic outlook is rather strong right now. So monetary policy, the Federal Reserve and printing of money. We have the interest rate cut later today. They're going to stop shrinking their balance sheet this fall. The velocity of money, so M1, the velocity of money is increasing, and the monetary supply just itself is increasing. We see that with the amount of currency and bank accounts that are out there. M1 has grown 11.6%, M2 8.9% in just the last 3 months on an annualized basis. This is extremely fast growth. Part of that might be because of this huge cash influx into the U.S. economy from overseas. So we have the new tax law that has repatriation, has caused repatriation to occur. And so we have hundreds of billions of dollars coming into the United States, companies bringing back their past foreign profits. And they'll do something with that money. They'll invest or pay dividends or expand or buy back their own bonds. This money is going into the system, and the next person to get the money probably is going to do something with it as well. Similarly, foreigners are buying U.S. bonds, and many of them would like to buy a European or Japanese bond, but given negative interest rates, they've decided to buy our bonds instead. So foreign money is coming into the United States to buy our bonds, and it might have a similar size as repatriation. The consumer is very strong, so there are more jobs in the United States today than ever before, and in aggregate, there's a 3.1% wage growth. So the consumer has more money with more jobs and with raises. The U.S. consumer tends to spend all the money it has immediately. So when we combine those trends, the consumer spending might grow at 5% nominal before inflation. And while business investment slowed in the first quarter, it's expected to we expect it to continue to grow at a nice rate. It's been growing at roughly 5% the last 2 years. Businesses need to invest in automation because they can't find as many employees or skilled employees. And they'll need to build some dual sourcing if they're afraid of tariffs or embargoes and trade problems. You won't want all of your manufacturing in China. You might bring some of it back home, or you might source from other countries. You'll have to build out the means to do that. But when it comes to trade, we are seeing improvements. We're not importing oil on a net basis anymore. We're exporters of energy. That's a huge difference. NAFTA 2 has been worked out. It just needs to be approved. And the main hurdle will be the U.S. Congress, and there will probably be increasing domestic and international pressure for them to approve the newest version of NAFTA soon. Tariffs have actually been lowered, but that's good news, so we won't hear much about that. The Chinese negotiations have restarted. They're never as fast as we want, but they're occurring. And the Japanese negotiations are proceeding quite well. We might hear in upcoming months of an agreement there. So in this environment, to cut interest rates is very odd because already the economy has a strong footing and the fundamentals are positive. It should continue to grow quite nicely. That doesn't mean all the stocks will do well. Some companies will be hurt by trends like higher wages. Other companies, as Mark said, are overvalued. But select companies will benefit from this environment, and many are undervalued right now. So we're finding a nice combination of attractive, growing companies at good entry prices, and we're quite positive about our stocks and the current economic backdrop. So I'll turn it back over to Brad for closing remarks.
Thank you, Tim. In closing, we continue to have a positive outlook on the market, supported by many of the positive forward indicators that Tim kind of just went over there. Furthermore, we expect the pending rate cut by the Fed, albeit unnecessary in our opinion, to provide additional momentum, especially in the short term, to an already strong economy. At this time, we'll take a break for just a brief second here to pull together all the questions we're getting in right now. Bear with us 2 seconds. Thank you. Okay, thank you. First question, are bond investments becoming unfavorable in balanced/conservative portfolios?
Well, we don't see much money to be made in bonds. So they can move in the opposite direction of stocks, so they can provide some balance in that respect. But you're not going to generate much income, or if you are, you'll have to take a lot of risk, which is not usually the reason why people are in bonds. So on a net of inflation basis, we don't think you'll make any money, and credit spreads are actually rather tight now, so you're not being paid to take risk. So we've taken the bond portion of accounts to the minimum level where it can go. So if somebody has a range of 10 to 20%, we're at 10%. And on top of that, since we're not being paid to take any risk, we're not taking any risk. We have a high quality, very short-term bond portfolios, and we can get yields in the range of 2 to 4% on a pre-tax basis. And so we don't find bonds attractive at this point. We have high conviction in a number of stocks, and so we do think the vast majority of money that we're going to make in the period ahead will be in stocks, not bonds.
Next question. There was a recent article in the Wall Street Journal highlighting the performance gap between the S&P 500 and the small caps over the past year. What is your rationale for why small caps have underperformed the broader market?
Well, this is Mark. I think one thing you have to realize about the S&P is it's become very concentrated in mega cap tech. So within the top 10 of the S&P 500, you'll find, if you add the two Google share classes together, they would be there: Apple, Microsoft, Amazon, Facebook. So if those stocks do very well, it's going to be nearly impossible for small cap stocks to do that well. But you do have a little bit more risk at the top in the S&P 500 than I think is most typical, because you've got this concentration of mega cap tech companies that have done quite well. Now, the fourth quarter of last year, we saw what can happen quite quickly with some of those companies that may trade at high valuations. Not all of them do, but some of those do. So it can be a short-term thing, but we think some of the small caps are very attractively valued right now. Tim, you probably have some thoughts too.
Lower interest rates help the smaller companies, and the smaller companies aren't as dependent on global trade or exports. So they will benefit from the current economic environment in aggregate. But again, you would want to be selective when looking at these. It's oversold area, so we're finding some very attractive names in the small cap area. We're also finding very attractive names in the dividend growth area, and you can easily make a stock portfolio that has a dividend yield greater than the 10-year Treasury. We find it very easy to create one that has a dividend yield greater than the 30-year U.S. Treasury. Interest rates are just too low, and when stocks in aggregate yield more than bonds, it tends to be a good point to own stocks instead of bonds. It's quite an extreme level, and we can even create what we believe is a growth and income portfolio that has a 3.5% dividend yield. So between small caps and dividend growers, we're finding some extremely attractive entry points today.
Great. We have a stock-specific question here. Do you think Greenhill will perform better in the second half than the first half?
Yeah, this is Mark. That dovetails nicely into what Tim was just saying about small caps and situations being undervalued. So the short answer to whether we think it's going to do better in the second half than it did in the first is yes, we do. We think it's going to have a nice reversal. There's a couple main, areas to focus on. One is the recap that they've done and they're continuing to do. They have $75 million left on their buyback, which based on today's prices would be roughly 22% of the company. They've completed a big part of the recap and they've hired some new MDs. managing directors, and these are the people that will drive the revenue growth in the second half of this year and into next year and the year after. So we think the revenue picture should be pretty positive, growing in the near future. The pipeline has been very strong. This company can be very lumpy based on timing of deals closing and deals being signed up. But if we look at their website, they've had a very strong growth in their pipeline. They have 15 deals in the second quarter versus just 9 last year, and their deal value is up over 250%. So the fact that they're buying back a lot of stock, or have the ability to buy back a lot of stock, and the deal values in the pipeline is so strong, we're confident that it's going to have a strong rebound. Interesting, they do report their earnings, their second quarter earnings tonight after the bell. So we'll get an update on how the second quarter went. We think it'll be positive. There's low expectations for the company. We think they're going to do a lot better than those low expectations, and we think they'll have a positive outlook for the second half of the year. They had a positive outlook for the entire year after the first quarter, which was not quite as good, and we think that there's no reason for that to have changed. The M&A cycle should be positive with interest rates so low, so companies can easily get funding to buy other companies, buy private companies and things like that to add to their growth, because growth is tough, but funding is easy. And also, you're not making hardly anything on cash, so the math on that works out, so you can make a lot of accretion from deals. Another kind of trading aspect is a lot of the stock is short. So roughly 15 of the float in our estimation is short. And when you have these high short interest ratios, any kind of sniff of positive news or whiff of change, you can get explosive price movements. So we've seen that with some of our small companies in the past that have, had explosive moves there was a high short position. So we think this is a candidate for that. Although, of course, we can't guarantee that. We feel pretty good about maybe that'll happen in the second half of this year. So we feel very positive about Greenhill.
There's another question: how to invest $10 million today if you were to have that. And it depends on your goals and objectives and constraints, what the timeline of the money is, and what how much risk or volatility can be withstood. If it's very long-term money and it's there for long-term growth, and volatility is not an issue, then certainly smaller firms can be more attractive right now. They're undercovered by Wall Street. Wall Street's had big cutbacks over the years, and so between undercoverage and being there's so many small companies and the aggregate undervaluation that we're finding, there's some great entry points. It can still be a diversified portfolio across sectors of the economy, and also with market capitalizations. There are plenty of attractive mid caps as well, and we're finding some attractive large caps. And then the other area that is very attractive, the dividend growers. In this low interest rate environment, some investors have moved just to the highest yielding investments and avoided companies with more normal dividend yields that tend to grow their dividends over time. And so there's some very attractive entry points with those. So a diversified portfolio, including dividend growers, including certainly small and mid caps, but yet broad exposure to growing areas of the economy. And then individual stock selection, making sure your entry valuation is attractive, and that the company's profit margins aren't being squeezed by where we are in the economic cycle, such as with rising labor costs.
And on that point, if you have $10 million on the sideline right now, you can give us a call after this webinar here. We can discuss it further. At this point, that's all of our questions. We'll give it a second or two here if any more come in. Otherwise, we have appreciated your time today, and we've tried to keep this brief, and hopefully if you have further questions, Tim, Mark, or myself are here to answer them always. So we appreciate it, and at this point we will go ahead and end the webinar here, and thank you for your time.
Thank you.
Thank you.